All right. Hi, I'm Nicole Lorg with eXp Realty, and Jeff Quincy at Green Home Loans is back with me this month for our next set of questions from our buyers and sellers. So Jeff, thanks again for joining me again this month to go and review the questions that came in after our last video. So I appreciate it.
Absolutely. Thanks for having me back.
So we're going to dive right in. And the first thing I really wanted to get Jeff to jump in before we start our questions is to kind of give us an update, a quick mortgage update on anything that's changed since our last video. So if you can just kind of take it from here on a quick update.
Yeah, so everything's staying pretty steady. I believe I talked about on the last video, if not, just give a quick recap, is I was anticipating and kind of predicting that by end of March, beginning of April, we'd probably start seeing the market become very, very crazy with low inventory, possibly rate coming down, more buyers entering the market. And what we've seen actually is as rates have remained volatile. There's been, there's a lot of reports we look at, inflation, jobs report, producer price index reports. These things have all been bad over the last 2 or 3 weeks. That has jumped those rates up a little bit. Nothing to be alarmed about, right? It's just a short-term blip. Ahead of next week's Fed meeting on the 20th. I think we'll see some positive movement there. But I think I would adjust my prediction on when things are going to get busy. We are seeing certain pockets, right? I have 4 units that went under contract this week, and 3 of those 4 were out looking for over 3 weeks. So there are pockets at certain price points, certain geographical areas that are going under contract quickly. There is competition. And then on the flip side, we still are seeing concessions, right? Half of our contracts right now are still coming in with some level of the seller contributing towards closing cost or rate buy downs to make the payments more affordable. So it just depends on where a buyer's at in terms of their price point and where they're looking in the valley. But otherwise, I would say, generally speaking, things have remained pretty steady and calm.
Yeah. And I was going to say, because a lot of people came back and asked about that. I think we made a comment about that last week about, well, where are these pockets at? And it's kind of hard because even in pockets such as like in town, like in Mesa, Gilbert, Queen Creek is a little further out where we're kind of seeing a little bit more balanced. These pockets, even though it may be a seller's market, we're still, the house condition is still having a lot to do with how quickly they're going to go under contract or if seller concessions are even involved there. Further out in Florence, we're still seeing it in the buyer's market more and kind of slowly get into that balanced market, but they're sitting on the market longer. So even though I posted on my page the Confer report and they're showing it seller's market, but it still has a lot to do with condition, location, that you're getting this, the seller concession is probably not going to be in those contracts, or they're going under contract a little faster. So it's not like seller's market, several years ago. They're quite different.
Yeah, I agree with that. And good point on condition of property, right? The ones that, and put yourself, for the viewers, put yourself in the buyer's shoes. If rates are high, payments are higher, you're expecting to now at the higher cost to move in ready.
Yeah.
And you're going to expect something in return. If it's not, and you see some elbow grease having to be put into that house, maybe some money into that house. So definitely, we have one that's being negotiated right now where it's in the listing that they'll give a flooring allowance, right? So you have flooring allowance. We're still asking for closing costs. It's been sitting for 60 days because buyers are seeing it's not moving ready. So very good point on the condition. It plays a huge factor.
Yeah. Okay. Anything else you had to add on that? You already talked about contract coming in.
Yeah, I think that's pretty much it. We've actually seen inventory tick up just a little bit, right?
Yeah.
Yeah, and so that's my reason for saying we're going to be pushed out a little bit here as to when we really get into that. So there's still a window here, and we'll talk about that at the end, right? Some planning steps that we can take. But there's still, I think, another 30, maybe 45 to 60-day window for buyers to get in and not be drowned out by the competition.
Yeah, exactly. Alrighty, so let's go ahead and dive into our first question. Again, we are only going to do 5 questions here, and there's some of these are a little bit more in depth, so it might take a little longer, but just bear with us here. So our first question here is, let's see. What's the difference between you, Jeff, at Green Home Loans and other local lenders, and even if they went to Rocket Mortgage or their local bank, for example, more like Chase, Navy Federal, things like that? What's the difference between you and those mortgages, more our lenders?
Well, of course, the first difference is I'm the best lender in town. No, joking. I
agree.
really am humble. So I'll talk about it from two different standpoints. One is what's the difference between the lenders, and then I would also go into the difference between me and other loan officers. So I would say first and foremost, as a mortgage broker in town, what that does is it gives us the ability. We work with over 100 lenders that, in essence, we're the middleman shopping for the best deal. Now, what I don't like, and you'll hear out in the marketplace a lot from other mortgage brokers, is we're the best. We shop for your best rate. Okay. I've said this in my 21-year career. I will say it until the day I retire. You are not looking for the best rate. We've been conditioned to look for the best rate, but even me with having 100 options, I will on any given day have 3 or 4 lenders that will be better than, say, my go-to lender in terms of rate. And I will not send them a loan because the chances of you closing that loan on time or even at all is very limited, right? It's very low probability. So anytime you're looking at the cost of anything, you have to think about, well, why are they cheaper? Well, they know their customer service is bad. They know their understanding of guidelines. Their underwriting staff maybe isn't as experienced. The process is slow. So they have to make up for that to get volume by offering lower interest rates, right? So as a broker, that's the main difference between us is we don't have any lender fees. You go to any retail bank, and I don't like using names, but you threw them out there, right? The Navy Federals of the world, any retail bank, the big banks like Chase, Wells Fargo, they're going to charge not only lender fees, which we don't have any, but in most cases, in a high rate environment, anybody who advertises online or has a big customer base, it's common for them to charge points. And we can do the same thing, but you're always going to get an honest rate quote from me with no points, because in this market, it doesn't make sense to pay points on an interest rate because we know there's a refinance coming sometime. It's not, if, it's when it happens. Now, when that refi time comes and these rates are back down to the new floor, wherever that is, 5.5%, at that time, that's when it will make sense to possibly pay some points for a lower interest rate, because now we know we're putting you in a loan long term. But right now, we know these loans are short term, whatever that means, right? 6 months, 8 months, 2 years. The other difference, and you brought up Rocket, just know as a broker, we work with Rocket. That's going to be the difference I share, because you will hear me say some negative things about them from time to time. However, they're one of our biggest and best partners that we work with. Okay. So it's confusing. Well, why do we see all these negative reviews about Rocket, yet that's who Jeff, who's been in the business for 20 years, is choosing to use? Rocket gets, and this is a number they don't disclose, so I'm guessing 90 to 95% of their business comes from brokers like me around the country. So we on the wholesale side as brokers get better terms than you get on retail. So I can pull up any one of my clients in their system and run and look at a rate sheet. I can go, Rocket publishes their rates online, and they'll show, for example, I might be at 7.25 today. They'll show on their website that they're at 6.875. But in the fine print, it says that this fee, and it bounces anywhere between 1.75% and 2.25% of the loan amount. So if you're on a $400,000 house, that could cost you $8,000 for that rate. Well, I can get that 6.875. I might only have to charge you $4,000. But then again, because of everything I just said, I'm going to tell you not to do that. Yeah, the lower rate feels better, but it has to make financial sense, right?
Right.
So that's a big difference on the business side of things. All we do is mortgages. We can shop for a combination of the best rate and customer service and customer experience. In terms of me, and the way I work over the 20 plus years I've been doing this, is I just take an educational approach, and my whole goal is to help people build generational wealth through real estate. A lot of loan officers, unfortunately, are transactional based. And what I mean by that is they're order takers. You come in, I want a mortgage. They send the numbers out to you. Hey, call me back when you're ready to go. There's no education behind it because they've been taught to turn and burn, right? Get as many apps in, close as many loans as you can. And we do a high volume, right? 3 years running of top 1% originator in the country. And one thing I will never give up is my educational approach to every individual client, because I feel like that's the missing piece in our country is people don't have the knowledge and the education to make the right financial decisions. And I'm still seeing it today, which is sad with the amount of knowledge that's out there. These loan officers, I'll get a second opinion client and they're like, I was already pre-approved, but I just learned more from you in 10 minutes than I did a whole month with the other lender. So that's the difference between me and most loan officers is I take the time, and if it takes 3 hours of phone calls over the course of a week, that's what we're going to do, right? We're not just going to give you, hey, you're approved for 400,000, here's your payment, here's how much money you need, and send you on your way. There's a lot more involved in that.
Yeah.
So does that answer that question?
Yeah, I mean, I even have one of the buyers that I sent over to you came back with the same thing. He got a second opinion, just another rate from his personal banker that his dad used for their loan for his mortgage, and he came back. He's like, I'm going with Jeff because he just laid it out for me. I understood it, and the banker could not do that. I guess the other thing I have a question on is, now, because you're the broker, you do work with Rocket Mortgage, we're dealing with you. The communication is between you and I, and not me and the Rocket Mortgage, and that lender that could be in the East Coast as well.
Great point. And sorry for not covering that. So I talked about the difference in cost and rate, right? But the real reason why Rocket's a great company, the reason why we use them when it makes sense for interest rates and whatnot, is because their process is so quick, right? I had talking about those lower rate lenders. We had a veteran we were helping, super clean file. So I was like, hey, I haven't heard anything negative about this company. They're pricing 0.25% better. This file with Rocket would have been completely done in 3 days. And we sent it to this other lender, and it literally was 3 weeks. We closed on time. We were still like 2-3 days early, but Nicole, you know our standards, right? My wife is my assistant. You know how we work. And it was the client didn't know any different, but for us, we're like, they pick that file apart. So Rocket internally, their process and the service we get is really good, but you're correct. Your point of contact is me. The reason why they have bad online reviews is because on their retail side, where they get a very small portion of their business from, that's a call center setup. Most of the time when you're dealing with call center employees, not always, you're dealing with people who aren't sitting in that chair as a career building a business, right? And they're probably there for a reason because they don't know how to build a business or they're starting their career. So because of that, you end up on a conveyor belt. And that's not your go-to contact, because internally for their retail side, that's not right. You come do a loan with me, I am your point of contact. Yes, you may
The whole time.
The whole time,
Yeah.
start to finish, day one to the last day. Now, you might hear from my assistant, Cece, sometime in that process, and she's working on some stuff with you, but I am your point of contact. You go, and not singling out Rocket, you go to any of these retail companies, if they have a call center, it is a conveyor belt. Every time you call in, you're going to get sent to somebody else where you have to re-explain your story. So it's not that they're doing anything bad. Their business process internally on the front end that I do, for them on their side, it's just simply broken, right? If they fix that, they would have a better, image out in the marketplace. And it's a byproduct of training and the employee skill set that they're hiring. So good point. But yeah, with me, you actually, other than your disclosure saying that they're from Rocket, you don't even know that you're working with Rocket. You're working with me and Green Home Loans.
Yeah. I mean, I've even had another national lender. We've the buyer wanted to stay with them, which I understood, but once they were done with the initial pre-qualification, we went to the next part of it, which was a different contact. So every phase of the deal, we had a different point of contact. And even though both parties wanted to close early, we couldn't get in touch with anybody on the previous phase to make it happen. And so we just had to stick with, just closing on time and the contract date. But yeah, that's what I noticed, is that there's different points of contacts for different phases of the deal.
We have one right now that came in 2 weeks ago for an April 10th closing. We're done. That loan's already done. And the client wants to move it up to April 5th. Right? Already done. Like, we already have the dates updated. Everything's balanced with the title company for the the 5-day quicker close. We're going to sign him the week before. And that's how we work. We get things off of, we do a really good job up front. That's why my wife is my assistant. She's a former mortgage underwriter. So we send clean files to underwriting. We know exactly what they want. And it doesn't sound like that's of importance to a client until you're in the process and people are calling you every day while you're trying to work. Because remember, we have to have that job and the income to qualify. The last thing you want is a call every day. Oh, now we need this. Oh, now we need this. And yes, sometimes we have to go back to clients as well, but it's usually not until the file's been underwritten and we need 1 or 2 items, right? My whole mission in the way I built my team is to minimize the times we have to go back to a client. So all important steps that you don't know until you're in the process.
Right. Yes. Yes. Okay, good deal. All right, let's go to the next question. And I've seen a lot, I haven't dealt with this, but I had actually a seller bring this up to me. They want to know, what's the deal with assumable loans? I have a 780 credit score. So what do I need to do to assume a homeowner's loan if they have a very low interest rate? And like I mentioned, I had a seller that had a 2.5% interest rate. He goes, can I offer that right away? Well, what does the buyer need to do in order to qualify for to assume that loan?
Good question. Assumable loans is a topic I have of conversation almost daily, right? Because it's very enticing. You got a FHA, VA. They're the most, it's rare that you see a conventional loan can be assumable. But these, during COVID, people were locking these loans at 2.25 to 2.75. That rate looks a lot better than today's rate. So it's all the rate. It makes sense if you can get an assumption completed. On average, the banks, I'm going to back up into the process, but on average, it's taking the bank 60 to 90 days to approve them. The downside is you don't know if you're approved or not till the end of it. So now that's a detriment to the seller taking their house off the market. The buyer has to be patient, fingers crossed, toes crossed, hoping that the final word when they get it is positive. I was talking to a title company last week. They just closed on an assumption that was an open escrow for 1 year.
Wow.
The average seller is not going to wait a year to do that. Eventually, they're not going to care about you getting that lower rate. So now that I explain how that works, I'll explain the assumption process and what a buyer has to do coming into that. So you actually don't, if you're trying to buy, so you're a buyer, the seller has a VA loan at 2.75. They're saying, hey, come assume this loan. The start of the process is you do not work with me. Okay, you work with Nicole on the real estate side, you submit a standard contract, and then you work with the seller's lender. So whoever holds that mortgage, you work with them, you go through a pre-qualification process with that lender called the servicer. Whoever you make your mortgage payments to is called a servicer. So you work with that mortgage servicer to get approved. You fill out all their paperwork, they review it, they determine if they'll let you assume it. The biggest drawback, and there are assumptions happening right now because of the rate market, the reason why you don't hear them happening at high levels is because let's say that veteran that owns that house wants $400,000 for his house. And you're going to assume his 2.75% interest rate, but the balance on his mortgage is $200,000. You have to bridge that gap and come up with that $200,000 in cash. And how often does somebody have $200,000 in cash to spend, right? It does happen, but it's not every buyer. So that's why you don't hear of them being successful as often as you think it would be. Additionally, what most people in the industry, real estate agents, lenders, and definitely buyers and sellers don't understand, that lender has no motivation to approve that assumption. If they're holding that loan at 2.75%, they're making hardly any profit margin on that loan by servicing it, right? They now know the seller wants to sell. So there's rules they have to follow. I don't even know them all, but there are regulatory rules they have to follow and be prudent and not be discriminatory. But they have every reason to find something in the file not to approve that assumption, because they now know the seller wants to sell, so they can get that low interest rate mortgage off their books. So not making any accusations that any servicers are doing that, but that's why it's very hard. The first part is always the lack of cash to make up the difference between the two. I have recently heard of one lender that will do a home equity line for part of that, but you still have to come up with some money. There's some drawbacks if it's a VA loan and the person coming in is not a veteran. They tie up their entitlement until that new buyer pays that loan off. So it impacts their next VA purchase. So both on the buyer and seller side, there's a lot of moving pieces there that can make that tough. If you're patient, time is not of the essence, and you find one, I would argue it's worth going through the process. I just wouldn't get my hopes up.
Right. Yeah. I haven't heard of very many. Now, do you think that because, like you said, it's just a cheap loan, so they're not in a rush to try to get, somebody else to assume that? Do you think that's probably why it's taking so long, is because, hey, we're not making money off of this one anyways?
No, I think that's plausible to think that might be the case, right? That they're slow playing it, hoping there's buyer fatigue and they just back out of the deal. I don't think that's the case. Have to remember, the only time assumptions are really big is when rates go super low, and then coming out of that, rates go super high. And those big swings don't happen often, right? We're in a very weird market situation that we haven't seen in a long time. So keep in mind, all these servicers around the country, they might have had a one-person department for assumptions, because they might see an assumption once a year. They're probably dual position doing that and something else. And all of a sudden this happens, and all of a sudden one servicer gets 100 assumption applications in a week. So I think that probably plays bigger into it, is the labor force to handle those assumptions just isn't where it needs to be. And they know it's a short-term thing, right? As soon as the rates come down, assumptions will go away. So they don't want to do a ton of hiring either. I would put more on that than anything.
Okay. All right. Let's see. This is another big, I think this is a 2 or 3 part question.
Okay.
This one is, I'm in an area where homes aren't selling very quickly. We've talked about that earlier, and there's homes that they really like. I don't want to miss out on the opportunity. Could I get a bridge loan to help purchase a new home, so I'm not a contingent offer? And what should I be aware about this option?
So I'm going to give the 30,000 foot overview answer to this one, because it's easier to go granular when we're speaking to a specific scenario. So the quick answer is yes, there are bridge loan options out there where we can qualify you for the new house, okay, and not count the current home in the debt to income ratio. That's usually the biggest caveat there, because if we can count both and you qualify, that's just a standard loan. You don't need the bridge loan. We can do that. It all runs through the same company. So the same company that gives you the bridge loan on the current house has to be the same lender we use for the new house. Conventional only. Okay, so you have to be using a conventional loan on the next one. So if you are a veteran, or if your credit score dictates that we need to go FHA, that bridge loan wouldn't be an option. They will lend up to 75% of your home's value. So for easy math, $400,000 value on the home, 300,000, 75% of that, and you owe 250, they will give you that $50,000 difference as a bridge loan down payment on the next house. They will then give you 90 days to sell your current home. They'll extend you. This company in their existence has only bought back one house. So if the 90 days comes and goes and it's still sitting there, they'll extend that. They don't want to buy the house. But the way they do it is they write an offer at your balance plus the bridge loan. So in my scenario, they write an offer on your house at 300,000. That's written that contract is invoked at the day 90 if it hasn't sold. But if they don't get sold in 90 days, they don't want to own it, so they'll extend you. But even if they do buy it, like the one house that they bought, they then turn around and market that. They can use you, Nicole, if you're the listing agent, to turn around and market that and resell it. And you do get the difference on what they sell it for minus fees, right? Similar to had they sold it on the open market. The downside is it's expensive. This company charges 2.4% of the sales price of your home. So if you sell a $400,000 house, after it finally closes, they're going to charge you, what would that be? $9,600 as a fee, one-time fee. You don't make any payments on the bridge loan. It's interest-free. They're simply going to get their fee and their money when the house sells. So it's kind of, I don't want to use this term. I don't want to use it loosely, but it's kind of an option of like last resort. Like the perfect house came along and I'm gonna cough up a little bit of my equity position to be able to get the dream house and not miss out on it. So
Mhm.
we do talk about it often. We don't use it a lot because there's stats by National Association of Realtors that says a empty house that has their minor repairs done, show ready, sells on average across the country for 4% more than occupied properties that are not show ready. Okay. So their stance is our 2.4% seems expensive, but if we allowed you to vacate and get it show ready and you make an extra 4, you actually came out 1.6% ahead. Here's the problem I don't like about statistics. That's a large sample size when you say 4% across the whole country, right? There's no guarantee you're getting an extra 4% to vacate the property. So, so that's the reason why we talk about it, but I don't see a lot of those being done.
Okay.
It's there as a backup plan, right? They list
Yeah.
the house with you. They know the bridge loan's a backup, and we literally sit until the house sells or they find the perfect house. And it's like, okay, we have to jump on this. There's so many other things you could do. You could lower the price of your house that you're selling to get it under contract. Yeah,
There's a
there's
lot
other options as well, but it's a possibility.
Okay. Now, our next question can kind of piggyback off of that, off of this topic. Let's see, and this is actually a question I got from a seller from our last recording. They said that we are thinking about renting our primary residence and buying a new and bigger home for a growing family. What's the best option for getting our down payment from our equity of our current home?
Yeah, so this one's a little bit trickier. Okay. You could do a home equity line to pull some of that cash out. My recommendation is to find other sources to keep yourself in a better home equity line. Rates are very high right now. Some banks won't let you do it if they know that you're going to vacate the property. You never want to get in trouble with occupancy laws and occupancy fraud. That's something that's looked at. So you got this one, you just got to be careful, right? We have to know the picture, the intent, and make sure we structure it correctly. Are there other ways we can access an equity? The other benefit of accessing the down payment through other means is that home equity line at that higher interest rate is really going to offset your cash flow on that property when you turn it into that investment property. So you're already starting off on the wrong foot. And most people think, well, I'll make extra payments and get out from underneath this. Home equity lines, if you don't get out from underneath it in 10 years, they can get very ugly very quick. And I won't go into the details of why. If this question pertains to you, call me and let's have a 5-minute conversation on the pitfalls of that. Too much to unpack here. That's one way. The other way that you can do it is through a refinance, right? Cash out refinance. Now, if you're one of those people that got 2.75, that's not going to make sense, right? Now you're affecting that cash flow. Probably doesn't make sense to turn that property into an investment property. So we got to look at the entire situation and determine what's the best way to access that equity, or do we have other means to just leave that put and leave you in a good leverage position on that new investment property. But we can do it. We're seeing a lot of it right now. A lot of people want to keep the low rate. They have, a $1,500 mortgage payment. Rents are $3,000. I'm a big fan. I never paint in broad strokes or talk in absolute. I am a big believer in once you own real estate, never sell it. So for that reason, let's find anything we can do to not have to sell it. If there's a method to get the access to it and help you purchase a new one. But a lot of people are looking to move up, right? Families are growing. So there's ways we can look at case by case.
Okay. All right. Let's see. And then our last question we have is, let's see, I'm sure you've addressed this. I've been to one of your first time home buyers course, and they want to see what credit score do I need to qualify for a loan? Where do my credit card balance need to be? So I think this would be a great time for those that have this question. Definitely go to Jeff's class next week, because he just lays it out.
So we have 2 questions: is a credit score and credit card balances.
Our balances.
Okay. So credit score is very easy for the most part. It's all over the place based on loan program and lender. Your standard basic is you need to have a 580 to do a government loan. So FHA and VA.
Mm-hmm.
Conventional requires minimum of 620, But if you have a 620, we're not taking you conventional. That will be a super expensive loan, regardless of your down payment. So usually the tipping point is if you're above 700, then we look at conventional, not always, but most times. If you're below 700, then we're looking at FHA. If you're a veteran, we're always doing VA. That's the best loan out there, period. No money down, no mortgage insurance. So are there programs that go lower? Yes. But you talk about rates being in the sevens. You go to those are called non-qualified mortgages. Okay. Back 20 years ago, we used to call that subprime. They don't like that term anymore, but those rates are going to be in the 9s to 10s, right? On those niche products that will let you go down to a lower score. I'm careful how I answer the credit score question because technically VA in their handbook does not have a minimum credit score requirement, but all lenders have their own overlays. So when I say FHA is down to 580, there are some that will go down to 560, 540. Now you're going to have to put 10% down instead of 3.5%. You're going to get a higher interest rate. VA doesn't have one, but lenders will have an overlay on that rule, and most lenders require a minimum of a 580 credit score. From there, there's other programs. You get into niches and stuff like that that we would talk about individually. You get into down payment assistance or some of these grant programs. There's some at 580, some at 600. 640 is the most common requirement for those programs. And then you have income limits you have to look in and layer into that as well. On the credit cards, I am going to give a blanket answer without seeing a credit report. The guideline is the first step is to get that balance under 50% of the credit limit. So you have a credit card with a $2,000 limit. You want that balance under $1,000 at all times. The next best move from there, and the optimal move, is to get that to 30% utilization. So $2,000 credit card down to 600 or less. That's a blanket statement. Now, when we run a hard pull of a credit report, it has a built-in analyzer that will tell us what can we throw money at and get an instant return on the credit score. And you will see weird things. Like you might have 5 credit cards and it will tell you to pay 3 of them to 0. It might tell me to, on the 4th one to pay it to $117. And the other one might be like, oh, just pay it down $100. And it's still over 30% utilization. That analyzer is looking at the entire makeup of your entire report and determining what the specific number is. So we will tell people, we'll give them the list right down to the number, and then they'll go pay down. Oh, I just paid this one off. I'm like, well, you're not going to get the same score impact because it wanted $117. We just had a gal that we helped do a rescore here recently. She had 6 or 7 credit cards, and they wanted 4 of them addressed. One of them was a balance, I think, over $12,000, and it wanted it paid down to $11,199, like exactly that number. So it wasn't like this huge, she didn't need to pay it off or pay it down to 2,000, but it was 11,199. So we have tools to help us with that in a more specific scenario on what we should do. Before you do that, though, you want 2 things on this. You want to have a conversation with me or a lender that you trust to give you advice. What I wouldn't want you to do is pause getting pre-qualified to wait for you to pay all the credit cards down. Because what could happen is you could be using down payment money. Say you're at a 740 credit score, or I'll go a different direction. Say you're at a 680 credit score, and paying all those credit cards gets you up to 690. Both of those credit scores are going to result in me recommending an FHA loan. So it didn't change anything. Didn't change the rate, didn't change the down payment, nothing. Now what we did, though, is we lost money that you could have put towards down payment. So you got to check first and get advice with somebody that you trust that knows credit report inside and out so that you're using your money the best way. The second thing, and I talk about this in our home buyer class, you have to understand as a consumer how your credit cards work in relation to your credit score. You will have people say like, pay your credit cards off, or even myself, pay it down to 30%. And early on in my career, I would give this advice. Hey, you have one credit card with $1,000 balance or limit. You need it always under 300. I give the advice. They would leave. I would say, let's follow up in 30, 60 days and check. I'd repull credit and they'd have a $600 balance. And I'm like, what? Like, well, that's what came out on the bill. I already paid it back down under 300, just like you told me, Jeff. So you have to understand the number on the credit report is the same number that comes out on your bill. So when your bill comes and says you owe $600 with a minimum $25 payment, the damage is already done. That number went to the credit bureau. So if you're trying to use your credit cards for whatever reason and have the certain balance that I've recommended, you now have to know when your bill cycles, and you got to go make that payment 1 week before the bill cycles so that when it comes out, it says the correct number and sends to the bureaus that way. So that's one advice I talk about in that course that is very helpful to people. Nobody understands that that's the case.
Yeah. I love that you said that, don't let, if you have a bunch of credit cards and before you start paying, don't let that stop you from going getting pre-qualified or at least having the conversation with your lender, with Jeff, because I actually had a buyer that just said, well, wait, I'm going to pay off some credit cards before I go and reach out to a lender. I'm like, wait, no, I'm like, don't. I'm like, have the
Might be the wrong
conversation.
move.
Exactly. I'm like, have the conversation, get a better roadmap to get you to the loan that would be best suited for you guys in your situation. So
Best use of your money as an overall picture, not just credit score, right? It's looking at the entire loan. And that's something that we talk about in the home buyer class, is just setting you up right. Look, the reason why I started doing those, and I think you were headed here, Nicole,
yes.
is people are scared. They're scared to talk to guys like me. And because I'm the scary loan officer, I'm not. I tell people in the class, I think you sat through it. I've been through anything on my credit report. You could have anything on your credit report. It's happened to me. So there's no judgment. That's why I'm passionate about what I do, because of what I've been through and the knowledge that I have to help people. So if that's you, come to the first time home buyer class and realize you don't need to be scared. It's not like here. You're only going to see me on the screen. It's actually difficult for me because I just sit in front of a screen for an hour and talk to myself.
Yeah. I don't know how you did it, because I'm like, I only see you. I'm like, I didn't see everybody else, where you kind of feel like you're not by yourself. I'm like, wow, he's doing a good job.
And could you even see the list of attendees?
No,
Like
no.
you couldn't even see who was there. That means they couldn't see you. I set it up in webinar mode on purpose for that, because I want people to come. And it's at 6:30 on a Wednesday night. If you want to sit there on your couch and listen with your significant other and be comfortable, great. Nobody can see you. But I want people,
right? You can
what's that?
submit questions to you live.
Yep. Yep, live. We keep the chat open so you can ask questions as we're in real time and get answers right then and there. Unless it's granular, and I'll say, let's talk off the record, right? We don't want to confuse people. Or I'm also very mindful of people's time. I try to keep it to an hour. I think both January and February, I went just a few minutes over. But that's important to me. I already appreciate that they're trusting me with their time. But the point of it is to be able to gain some knowledge and hopefully just allow you to take a deep breath and be like, this doesn't have to be scary. It's just the necessary next step. You'll see this in the class, but you're passionate about it. If you're listening to this and you're a renter and you're thinking, gosh, I go, you're not going to be put on the spot. I'll see your name, right? If I've never talked to you, I wouldn't even know who you are. There's a slide in there about net worth. So we'll give a little teaser, Nicole. I didn't tell you I was going to do this. I have a slide in my PowerPoint. The Federal Reserve Board did a study on consumer finance, and the average renter has a net worth of $10,000. Okay. In short, net worth is all the assets you own minus everything you owe, right? Liabilities. That's your net worth. Average renter has a net worth just under $10,000. The average homeowner in America has a net worth of $396,000. So if we take emotion out of it and we take all that out of it, and you just had door A or door B and you knew what was behind it, which one are you picking? 396. Yet we wake up every day and we're running busy lives. Inflation's out of control. It's expensive to live right now. It's scary to think about getting qualified. I might get bad news. You're never going to get bad news with me. If you can't qualify today, we're going to put you on a roadmap and a plan to get you there. And that class is kind of like step one. But we, of course, like emotionally, will always, or I should say logically, will always pick the $396,000 net worth over 10. But emotionally, fear and being scared will prevent us from taking the first step to see if we can go do that for ourselves and our family. So just a little teaser on what we go over there and why I'm passionate about it. Like real estate has afforded me the ability to do a lot of things, right? I have a nonprofit that I'd never never would have believed 20 years ago I'd be building basketball courts down the Caribbean. Like, we own another business that's expanding nationwide, and just did a huge partnership with a $3.5 billion company. Like, these are things that real estate has given me, some nobody from a small town in South Dakota. So I want to see other people win through real estate. So
Absolutely. I love that. Yeah. Okay. So that is your class is next Wednesday at 6:30. The 20th.
yep, Wednesday the 20th at 6:30 via Zoom. Nicole, I know you'll include the link. You do have to register, and then you'll get the reminders and everything there. And we would love to have you.
And the Zoom link will be sent to you, which is why you have to sign up so you can have that that link to enter into the class.
Yep.
Okay, yeah, I will have that in the description below. Well,
Okay.
that's our 5 questions for this month. And again, if you have any questions you would like us to address on next month's recording, just please send it over to Jeff or myself, and we'll be sure to answer it. Again, Jeff, we'll be having, I'll leave the link to it in the description next Tuesday. But also, Jeff, I'm going to actually toss it back to you to kind of close this out with anything you would like to add.
Oh, geez. I don't know that I have anything to add other than thanks for giving me the platform to share the knowledge. I'm passionate about just helping people. And so if you have any questions, mortgage related, reach out to me, come to my class. I think it's a great first step. If you have anything real estate related, 100% reach out to Nicole. She is in your corner. She's going to go to bat for you. And in this market right now, where we're talking about negotiating, like, we sit up here and we talk and we just sound like, oh yeah, we're going to get concessions. We're going to get your closing costs. And it's like, there's negotiating skills that go into all of this, right? And you got to be working with the right people. So Nicole, thank you for having me and, allowing me to pour into your tribe, and just excited to help anybody and everybody that's willing to take the advice.
Yeah, absolutely. All right, everybody. Thanks again. We'll send a reminder again about the class, as well as when our next Zoom call will be, or recording will be for our next 5 questions. Have a great day, everybody. Bye-bye.
Thanks.